Hello everyone, Ignatius Jackson CPA here with another awesome video for you. Alright, so today we are talking about short-term rentals Q&A. So I'm a part of a group called Short-Term or Build Short-Term Rental Wealth on Facebook, okay? And one of the moderators and group experts in there, Ryan Bakey, a good buddy of mine, that knows a lot about short-term rentals and real estate and stuff like that. We've even had him on the YouTube channel before. So he posted a question in there. What real estate tax questions does everyone have as we wrap up this year? And there's 165 comments to that. There were some good questions as I was reading through there. And so I just thought I'd do a little video to touch on some of those and bring them to you here on the YouTube channel. So hopefully everybody enjoys this one. And go ahead and don't forget to like, subscribe, and pay attention to the video and leave some comments. All that good stuff. We love it when you leave comments, and we will do our best to respond to you. So go ahead and stick around. We're going to be right back in a second talking about short-term rentals Q&A. Be right back. All right, everybody, and we're back. So again, today we're talking about some short-term rentals, Q&A, tax tips, strategies, all that good stuff as we approach the end of the year. Again, this is from the Facebook group Build Short-Term Rental Wealth. And again, shout out to Ryan Bakey for posting the question and giving me permission to go ahead and go through these. I wanted to have him actually on the YouTube channel to go through them with me so he can add in his 2 cents on some of these things, but he wasn't able to make it, unfortunately. We'll bring him back onto the channel though in the new year and get some additional insight from someone that knows his stuff as well. So, all right. So first question that's on here that we see is, my understanding for bonus depreciation, it's based on when you put in service, but I recently heard a conflicting comment from, I don't know who this is, Clint Coons, I guess. Say I buy December 2022, but put into service on January 2023, and I'm getting 100. Am I getting 100% or 80% bonus depreciation? So as many of you may know, starting in 2023, bonus depreciation goes down to 80% instead of 100%. Okay, so when you do a cost segregation study, those assets that have a shorter life than 15 years are now only going to be depreciated 80%, and then the rest would have to be depreciated over the normal depreciation schedule for that asset. Okay, and so his question is, if you put it in service, can you get 100% bonus depreciation still, even though you don't do the cost seg until 2023, for example? The answer to that is yes, you can. Okay, so all you have to do is put the asset into service. You have 2 options at that point. You can either do the study and count it for 2022, assuming it's for your benefit to do so, okay? Or you can do the study in 2023 and then go ahead and count it for 2023 tax year and do what's called a 489A adjustment, which is completed on Form 3115, okay? On your tax return, you attach that to your return, and you get to take credit for that bonus depreciation next year in 2023 at the 100% bonus depreciation rate, because the asset was placed into service in 2022 when it was 100% bonus depreciation. Okay, so that essentially is the answer to that question. There's a bunch of other replies in here and some other things in here. One of the things that I think Ryan chimed in on and mentioned was, what does in service mean? To me, that means, or to him, that means available for rent, right? Which is fairly valid. That's a good indicator of available for service, right? But when you're talking about short-term rentals, you have to keep in mind, in order to prove that you're a short-term rental, what do you have to do? Have an average stay of 7 days or less. 7 days or less. 7 days or less. Okay. So if you don't have 7 days or less as an average stay, you can't be a short-term rental, which means the exception that allows you to take losses is out the window because you're not a short-term rental for that year. Okay. So what that means is you have to actually rent it out. So it's not just available for rent, you have to actually rent it out in order to qualify for the short-term rental exception. Um, Now, that said, if you wanted to just treat it as a long-term rental, for whatever reason, let's say you have other long-term rentals that are profitable and you want to use some of that income to offset the long-term rentals that you have, then that's fine. Yeah, you can just make it available for rent. And when I say available for rent, people, I mean it's got what it needs to in there, okay, for people to rent it out. It's listed and someone could in theory move in the next day. Okay, that's what I mean. That's what we mean when it says available for rent. Okay, but that is basically the in-service date, and I would agree with that. All right, but just kind of keep in mind if you're doing the short-term rental exception um, under the 1.469 regulations, all right, then you're going to need to have the average stay of 7 days or less before you can do that. Okay. The next question is any syndications with decent 2022 depreciation passed on to LPs that you'd recommend? So we have some responses here. There's someone named Brian Dickerson and Jason Kane that people mentioned. I think it's through a company called Stomp Capital. Again, I'm not recommending these people. This is just some places that people have mentioned in this thread, okay? And then I'll tell you some others that I know of. You do like Grant Cardone's fund. I think he has a fund that's still available. You could do Fundrise. You could do, there's Realty Mogul, I think is out there. So there's quite a few syndication type things. Also some Regulation A type things that you could do before the end of the year and potentially get some bonus depreciation from those activities. Now the Regulation A items, you usually get a 1099 div form, so chances are you're not going to get any bonus depreciation from that. In order to get that, you're going to have to really have a like a true syndication, like where you're a member in an LLC or some sort of partnership. Okay, so just keep that in mind. Next question. This is our first year with short-term rentals. So I flip houses LLC as an LLC, not an S corp. Can bonus depreciation from a short-term rental erase the tax burden from the flipping business? Yes, in theory, as long as you qualify for all the qualifications and everything, then yes, in theory it could. The only thing it's not going to reduce is your self-employment tax because you're treating yourself as a single member LLC, which is disregarded for tax purposes, which means you basically are filing that on a Schedule C, and so you're going to be subject to self-employment taxes. And if that's the case, then you're going to have to still pay those because your losses from the short-term rental will only reduce the income tax, not the payroll tax. Okay. Now, one thing you could potentially do to get yourself into a situation where it would reduce the payroll tax as well is if you provided substantial services, because we all know when you provide substantial services as a short-term rental, that creates it and makes it a business income on Schedule C that is subject to self-employment taxes. Okay, so that's one way you could potentially reduce both sides of the income tax and payroll tax or self-employment tax. Okay, but other than that, yeah. I will also say, generally, if you are making more than $50,000 in profit a year flipping houses, you should probably be an S corporation. All right, so just something else that I'll throw out there is something that you should really consider for the person that asked that question. All right, so I used a DIY. Next question here. I used a DIY, do-it-yourself online cost seg last year and grossly overestimated the land value. When I got new property tax bill, the land value was considerably less. Do I chalk it up as a learning experience, or is there something my CPA can do to adjust and add the depreciation to this year? I think you're either amending your return or chalking it up. I don't think you can go and do an adjustment for this year. And even if you could, I don't know that it makes a whole lot of sense. I think the best thing would be to redo the cost seg and amend your return. Okay, because essentially what happened is you had the wrong numbers on there, and so it's an error of your tax return, and that is eligible to be amended. Okay, you're not changing your accounting in this case, you're just changing the math because you put too much land value to it. All right, So I think that would work in this case. Um, and so yeah, I think that's what your option that you would go with. Okay, so that's that question. Next question: how do you determine if the cost seg study is worth the offset of taxes or income? This is my first short-term rental in service this year. We both have W-2s. I just changed careers to real estate full-time in August. As a property manager, project manager, not related to our short-term rental. Okay, so you got a lot of things in here. So if you just change careers to be a full-time property manager, project manager, and now granted this is in August, so you may not meet the real estate professional status, right? But if you do meet the real estate professional status, I wouldn't even be too worried about the whole short-term rental exception, to be honest. I would just treat it as a long-term rental and call it a day. Okay. So there's two different things you can do there. Now, if you don't meet the qualifications for a real estate professional for this year, and you're trying to get some benefits from the cost seg, you're going to want to analyze it by generally what I would recommend, just a high level analysis. You take your purchase price of the house or the multifamily complex, you multiply that by 20%. That's going to be your land value typically. All right. Actually, let me restate that. You're going to take the value of the house that you purchase, you're going to multiply that by 80%. That's going to be your building value typically, right? Okay. And then you're going to take that number and multiply that by about 20%. That's generally what's going to be your additional depreciation in year one. So it ranges somewhere between 15 and 30% usually on the cost segregation studies of your building basis. And so I'd say on average, I'm seeing about 20 to 25%. So if you take 20%, that's a pretty conservative estimate, I would think. And if you do that, apply that times your tax rate, your marginal tax bracket, that would apply to that. And that's how you determine if it's worth it or not. I mean, it's just some quick math. Okay. So giving you a little bit of the keys to that calculation there. So hopefully that helps on that if you're trying to determine if you want to do a cost segregation study or not. So the next question is, if you buy a short-term rental property and then 1031 into another in the same year, can you take bonus depreciation on both? I don't really think that works. First of all, I don't really think you can. I don't know. I have to double check and look into this a little bit, but I think you're a little bit fuzzy on whether you can even buy property and do a 1031 in the same year for that same property. Seems a little, I don't know if that works really. Um, as I'm thinking through it, I mean, you could get into some situations where, I don't know. I just don't see that it works. But assuming it did, can you do bonus depreciation on both? Absolutely not. So when you do a 1031 exchange, your basis is going to basically carry over from the old property. All right. So you're not going to get a whole new basis in the new property. That's one of the drawbacks of the 1031 exchange. Okay. So yeah, I don't think it's going to be worth it in most cases, even if you could do it. But looks like some people are saying that you can. So, I mean, I guess it's possible, but I don't know. I just feel like there's some trap there that we probably would have to get over or get through. But anywho, that's the point on that one. Next question: how can you deduct health insurance and auto insurance costs as a part of your real estate business? So it depends on what type of business we're talking about. If we're talking about real estate rentals, you're generally not going to be able to deduct the health insurance based on that because you need to have self-employment income to deduct the health insurance, right? But the auto insurance, we could generally probably get that done if you are driving that vehicle the majority of the time for the business. Okay. Or we just include it as a mileage deduction, as a part of your mileage deduction, essentially. Okay. So, yeah, that's possible. We could potentially do the auto insurance, but the health insurance is not quite that likely when it comes to rentals. Okay. Now, if you have a flipping business or wholesaling business or real estate dealer type business, where you're filing that on like a Schedule C or an S corporation or C corporation, then yes, you should be able to write off your health insurance cost and also auto insurance costs, assuming you're using actual deductions for your auto. Okay. Next question. I have a full-time salary W-2 with flexible hours. It affords me the ability to keep an active real estate agent license, only 2 sides this year, and self-manage 3 long-term rentals and 1 short-term rental. Is there any chance I could pass the sniff test for real estate professional, or does my full-time salary W-2 pretty much prevent that? Assuming that full-time salary W-2 is outside of a real property trader business and you don't own 5% in that company, okay? So in order for that W-2 to count, you'd have to own 5% of the company and it needs to be in a real property trader business. So assuming that doesn't jive, right? The chances of you doing more than 2,000 hours or 2,080 hours in your rental real estate activities with only 4 rentals is pretty hard to believe. Okay. I'm not saying it's impossible, but you'd have to really document that bad boy. So maybe you bought all 4 during the year and you literally spent every free hour that you had working on it, developing it, getting it ready to rent, something like that. Maybe you might be able to get there, but that'd be a really, really tough test to pass in that situation. Okay. And I'm only aware of one court case where someone was a W-2 employee and they won the real estate professional status qualification. Okay. So usually people that are W-2 employees are losing that in tax court. All right. If the IRS is coming after them. So there's your answer to that question. Next question. Can you write off a gift card you were giving a cleaner? If so, does it have to be under a certain amount? What category is it logged under, i.e. supplies? Yes, you can pay them with a gift card, okay, but you can't write it off as a gift unless it's under $25. I know it's a really low amount. They really should increase that. It's been that way for decades, as far as I know, or years anyways. So they really need to decrease that or increase that gift amount. But that said, if you really want to take a deduction for it, then treat it as an additional payment for service, which at that point, you may as well just give them a cash bonus of some sort and just give them extra cash instead of giving them a gift card. Okay. So yeah, I would probably do that. But in theory, you can pay them with a gift card. It's treat it same as cash, basically, in terms of, sending them a 1099 at the end of the year that includes that amount on there. Okay. So that's the answer to that question. Next question. Material participation logging. Can we start when I have a signed contract or closing? At the boot camp, I thought you said when under contract, but someone else told me different. So I think Ryan and I are on the same page on this one. Once you have a signed contract on that property, that's when your material participation can start. Okay. So reviewing the loan agreements, reviewing the contract paperwork, dealing with the inspection of the property, making sure that everything is good to go before closing. I think that all counts. As long as you obviously close on the property, then material participation starts at that point. So I think that's the answer to that question. All right. Next question. My CPA won't let me count my short-term rental losses to offset my W-2 income. Bad CPA. Get a new CPA. Anyways, why? How can I use my losses from starting a short-term rental this year to offset my W-2 income? All my rentals are less than 7 days and I self-manage. Again, if they're that ignorant, get a new CPA. If your CPA is not willing to grow with you and help you save money on taxes, get a new CPA. I don't know how else I can explain that to you. I mean, I don't even know why you're asking this question in this group. Like, seriously. Let me not say that. Let me give them the benefit of the doubt. All right. It's just common sense. If you're not getting the service that you want from someone you're paying to provide services to you, go find someone else. I mean, that's just, there's no other way I can express that to you. And there's plenty of people out there that understand the short-term rental exception and will help you get that taken care of. And it looks like you easily qualify. So it should be good to go. Next question. I have 2 short-term rentals. Number 1 was purchased this year and for which I materially participate in. And number 2 was bought 2 years ago in which I don't have a material participation anymore. I intend to start material participation for number 2 next calendar year. So is it worth it to do the cost seg for short-term rental number 2 this year, or is it better to wait for material participation and then do the cost seg for short-term rental number 2, even though bonus depreciation reduces to 80%? I'm in the 37% tax bracket. Also, is there a cap on how much W-2 income tax I can offset? Or can I simply carry forward losses of the cost segregation for both properties exceeds my total taxes paid for 2022? Whew, that was a big one. There's a lot in that question. All right, let's hit that. Okay, so first of all, if the property is put into service this year, even if you do the cost segregation study next year, you're still going to get 100% bonus depreciation. We already covered that earlier in the video. Okay. Secondly, in regards to how much you can offset on your income from your W-2 job, there are some loss limitations. I mean, unless you bought a property that's worth like a couple $1,000,000, you probably won't reach that loss limitation, to be honest. It's about $500,000 married, $250,000 or $270,000, I think, individual, something along those lines. So, or 270,000 single and 540 married. Sorry, they actually increased it a little bit. So, yeah, I think you're probably fine there. I wouldn't worry too. I haven't come across anyone who has actually reached those limits and had an issue with taking the losses. Worst case, it just carries over to the next year and you use it next year. Okay. So I don't think it's that big of a deal. But yes, to answer your question, you still get 100% bonus depreciation. So there's no need to try and rush to get that done for this year for that short-term rental cost seg. Just go ahead and do it next year. I have a short-term rental that I bought in March, rehabbed, and put into service in May. Purchase price was $425,000, and I put $40,000 into the rehab. It's my first and only short-term rental. Does it make sense to spend $4,000 for a cost seg? My only other source of income is my W-2. Again, so if we do the math on this, all right, so you have $425,000 that you purchased this property for. Let's assume that the land is 20%, so your building basis is $340,000. Let's multiply that times 20%. That's a $68,000 deduction. Multiply that times your 37% tax bracket. That's a $25,000 tax savings. And that's just for federal. I'm not sure if you have a state tax issue or not either, but that's just for federal, right? So yeah, I mean, if you spend $4,000 to save $25,000, what do you think? I'd say it's worth it. So that's how you kind of analyze that and figure that out. And as long as you materially participated in that activity and it's a short-term rental and you follow all the rules there, then yes, you can offset your W-2 income on that one. Next question. If you borrow from a HELOC to dump into a real estate fund or syndication, is the HELOC interest tax deductible? Very likely. You could go ahead and deduct that. There are some traps to get through, though. You're going to want to take a look at a revenue ruling. I can't remember it off the top of my head. I'll have to see if I can find it, and we can post it in the chat here afterwards. But you're going to follow a revenue ruling to make sure to see if you can do it. What you would do is you're going to treat it kind of like an unreimbursed partner expense on Schedule E, page 2. You're going to put it on a separate line as a negative amount that offsets your income from the syndication, or if you have losses from the syndication, then it adds to your losses. All right, and it's going to ultimately have the same nature as the activity that's coming through the syndication is how it would flow through. So it is possible to do, but it's not as simple as just deducting it. You have to do a little bit of work on that one. Next question. We bought a vacation rental in May of 21 and put over 100,000 into it with a theming remodel that took over 7 months. Our first guest arrived December 27th to January 3rd. So we didn't make any money off of it until 2022. Can we write off that $100,000 on our 2022 tax returns? So I don't really understand what the issue is on this one, to be honest. I don't know if you didn't materially participate for 22, what the problem is or what the question's kind of getting at on this one. So, but let's assume that what you're asking is, can I take the $100,000 as a deduction in 2022, even though you spent some of it or most of it in 2021? Yes, as long as the asset was not placed into service until 2022. No, if the asset was placed into service in 2021, which it seems like it was placed into service in 2021 because you said they arrived on December 27th to January 3rd. So I think you'd have to actually factor that in for 2021 in terms of those assets that you were working on. And so you might need to do an amendment to your 2021 taxes. That's just my 2 cents on that one. Yeah, I'd be a little. I don't know. I need more information on that one, but I think that's what you're trying to get at. So I think that's what you would do there. Next question. So what exactly is the personal use of 14 days? What if I'm under and what if I'm over? So what you're talking about is you can actually utilize a short-term rental for 14 days or 10% of the days that it's available for rent or rented out. Okay? Meaning you can technically almost get about a month in as long as you are renting it out, a little over a month actually, as long as you're renting it out every other day of the year. Okay? So, or you can do 14 days, whichever is less basically, or whichever is greater, excuse me. 10% or 14 days. And so from that standpoint, yeah, I mean, you can utilize it. Now, be careful if you're using a retirement account. You obviously can't do that if it's inside your retirement account. But if it's a taxable way that you're doing this, then sure, go ahead and do it. Now, if you're over that amount, then you you don't want to be over that amount. Let's just put it that way. So, because now you gotta treat it as, yeah, just don't be over that amount. It's very detrimental actually to go over that, and because you're not gonna be able to take any losses. It's now basically going to be capped at whatever profits you have. So yeah, it's just not a good thing to do. So make sure you stay under the 14 days or 10% of the number of days that it's available for rent. Next question. There's another question about the bonus depreciation. Again, it's the same type of questions, same type of answers. So I'm not going to go over that again. All right, next question. I love this one. So I have one short-term rental and one long-term rental. Should I set up an LLC before the year ends, and can I pay my kids out of it? You don't have to set up an LLC to pay your kids, first of all. All right. Second of all, yes, you can pay your kids. So as long as they're working in the business and you have a legitimate reason why you're paying them, you can absolutely pay your kids for helping you with your rental business. And if they're under the age of 18, there's no payroll taxes, no income taxes. Don't have to issue W-2, don't have to do a 1099, all that good stuff. Okay. Now, you can do a W-2 if you want to. Definitely don't do a 1099 because that's going to make it subject to payroll tax. In theory, you could do a W-2 if you really wanted to. It's not necessary, no matter what anybody tells you. No one's ever, I'm not aware of anyone who's ever actually got a penalty for not issuing their kid a W-2 when they're doing that strategy and they're under the age of 18. Okay. I mean, don't get me wrong, it probably has happened. I'm just not aware of it. I've never encountered that issue. Okay. So, but yeah, you can do it. Now, the LLC is another question. I mean, you should generally have an LLC for the short-term rentals period from a liability standpoint, but it's not necessary to pay your kids. Next question. My short-term rental was for 23 years, my primary residence. I rented it for the first time in 2018. I did not depreciate it on my taxes from 2018 to 2021. It's my understanding that I am required to take depreciation on it. I didn't because I didn't want to recapture it if I sold it. Advice on this: amended returns and start depreciating it. This is a very common misconception out there that if I don't take the depreciation, then I don't have to recapture it. That's technically wrong. Okay. So the tax law says that if you don't take the depreciation, then you have to act as though you did, and you still have to recapture it. So you basically lost out on all those deductions over all those years. because you can only go back and amend for the last 3 years, basically. Okay. So your 2018 return, I think you've actually, let's see, 19. Yep, you can no longer amend your 2018 return. It's done. So you lost out on that deduction forever for 2018. All you can do is go back and do 19, 20, and 21. Okay. So I'm not sure who might have told you that you could do that, or if you're just doing that kind of a DIY thing. There's one benefit of having a professional help you with your taxes when you start doing stuff like this, because you could be missing the boat on something like this. So there are some people that were responding that said you can file a 3115 to correct the depreciation. I don't know that that's accurate. I don't know that I agree with that one, because here's the problem. A 3115 is used to change your accounting method. In this case, it was an error. You're not changing your accounting method. You're basically trying to take depreciation that should have been taken in a previous year, which is kind of what you're doing when you're changing the accounting method, but it's a little different to me. I don't know that I agree with that. So I'd have to double check on that and look into that a little bit more. If that's the situation that you're dealing with and you're one of my clients, let me know and I'll dig into that for you, because I don't know that I agree with the 3115 methodology. But yeah, so you definitely are going to get charged for the recapture though. Let's see if there's any other questions that haven't been duplicated here. Okay, so next question. If you have expensed the purchase of a vehicle in 2021 as a business expense, but the vehicle is financed, can you expense the interest until payoff? Yes, you most certainly can do that, assuming that you have 100% business use each year, or whatever use you initially depreciate the vehicle over. Okay. Now, keep in mind, if you bonus depreciate a vehicle and take 100% in the first year, but then your business use drops below 100% in future years, you actually have to recapture some of that depreciation you previously took. So that's one thing you got to be careful about with taking actual expenses for vehicles, is if you drop below in a future year and you bonus depreciated it, right, you're going to have to take some recapture expenses. So, but yes, and there you can write off interest until you pay it off. Okay. Even if you do mileage, by the way, you can take an interest deduction on a loan for a vehicle, because interest is not included in the mileage rate. That's something that a lot of people actually forget about and miss. So keep that in mind. It might be easier just to do the mileage rate sometimes. A lot of people are looking for people to help them with their taxes in this group. So, all right, great question here. Next question. To meet the 100-hour material participation rule, do you need to track other people's time to prove you worked at least 100 hours and more than any other person? How is this accomplished? Yes, absolutely you do. That's the hard part about that rule for the material participation test. You would need to track everyone else's time. Now, if all you have are cleaners, what I do is I have my cleaners put that on their invoices, how many hours they spent cleaning every time they clean before I pay it. Okay, same thing I would do probably with the contractor or repair person, have them notate how many hours they took to do it on the invoice before you pay it. So as long as you do that before the business, or before you pay someone, you have more control over asking them for that information. Okay, but yeah, that's the easy way to kind of go through and track it. Now, again, if you have a property manager involved, you're probably not going to meet that test, just FYI. But there you go. All right, next question. If I am a REPS, meaning real estate professional status person, okay, making my income all active, can I write off depreciation losses from investing as an LP in a syndication? If you meet, the only way you're going to be able to do that is if you meet the 500-hour test and you group everything together, okay? Otherwise, you're going to have to meet one of the other criteria with all of the material participation tests, with other material participation tests on an individual basis. So yeah, assuming you meet the 500-hour tests, then yes, you should be able to do that. The problem with the other tests on the LP syndication, even if you group them together, is there's no way to prove what the other people have spent in that business. And usually they're going to be spending a lot more time than you are, obviously. So it's hard to add that to your other items to qualify under that grouping election. So yeah, I think unless you do that, you're probably not going to be able to make that rule. Well, there you go. I think that's the last question. Everything else, all the other questions are a little redundant. So, well, Man, that took a little while longer than I thought. There's a lot of questions in there. So, well, hopefully that was helpful to everybody. If you're thinking about doing the short-term rental exception, it's a great strategy. I've done a video on it previously. We talked about it as well with the interview I did with Ryan Bakey, who is the author of this post in this group. So, I mean, yeah, if you haven't joined this group yet, feel free to go and find it on Facebook and join it. There's a lot of good stuff in here, a lot of tips and tricks on how to start a short-term rental business and help you to grow it and all that good stuff, as well as save some money on taxes while you're at it. So that was today's YouTube video. Thanks everybody for tuning in. Don't forget to subscribe, like, comment, all that good stuff. Help us grow the channel. We really appreciate it. Hope everybody has a good one. Talk to you later.